Most investors have a specific financial goal in mind: accumulating $1 million, buying a real estate asset, or securing their freedom by a target date. But if you ask them 3 simple questions: exactly how much do you need to save every month? What exact return must your portfolio generate? And on what exact date will you hit your goal? Silence. Most people are investing completely blind. They deposit random amounts into random assets, cross their fingers, and hope the market figures it out for them. But hope is not an investment strategy. Worse, most investors make one fatal mistake: calculating their future goals in today's money. To have $1 million in real buying power 18 years from now, your portfolio doesn't need $1 million. It needs over $1.57 million. Inflation silently eats your progress while you guess. Institutional capital doesn't guess. They work backward. They reverse engineer the exact time, monthly savings, and required return to hit a real number. Here is how to audit your plan before time runs out. To reverse engineer any financial goal, you don't need market intuition. You need a mechanical protocol built on variable isolation. Every wealth target depends on 4 operational variables: target inflation rate, the expected purchasing power erosion, defaulted at 2.5% annually; time horizon, the exact number of years required to hit your objective; monthly capital velocity, the precise capital injected into your portfolio every 30 days; required annual return, the net yield your assets must generate to bridge the gap. Retail investors calculate their targets in today's money and pray for the best. The reverse engineering protocol operates differently. You input your real purchasing power target, say $1 million. The system instantly calculates your nominal target, accounting for inflation. Then, using a strict goal-seek mechanism, you lock your non-negotiable parameters and solve for the single missing variable. Need to know the exact timeline based on your current savings? Solve for time. Timeline locked, but cash flow is capped. Solve for required return to see if your risk exposure is realistic. Target date fixed and return expectations conservative. Solve for monthly savings to expose your exact capital shortfall. You lock the facts, and the system forces total clarity. Let's examine a realistic scenario using the Wealth Goal Calculator. Suppose your objective is to accumulate $1 million in real purchasing power. You start with an existing capital base of $250,000, and you inject a monthly capital velocity of $2,500. We lock the solver mode to time and set the expected nominal return to 10%. Accounting for a standard 2.5% annual inflation, the engine reveals 2 hard facts. First, your true nominal target is approximately $1.31 million. Second, the exact timeline required to reach your goal is 11 years. The math is ruthless. But what if that timeline is unacceptable? What if you demand to hit your goal in under a decade? You have 2 mechanical levers. Lever 1, increase your monthly capital velocity. By bumping your contribution from $2,500 to $3,500, the engine recalculates instantly, pulling your target date safely under the 10-year mark. Lever 2, solve for a higher yield. Pushing your required return to 12% also breaks the 10-year barrier. But the math dictates you must accept a higher risk portfolio architecture. This is how institutional capital operates. You weigh capital injection against market risk in real time. No blind spots, just the equation. Stop gambling with your future. Go to proactivepensionmanager.com, launch the Wealth Goal Calculator, model your exact trade-offs, and take mechanical control of your timeline today.